If you're looking for dividend stocks to buy and hold forever, a good place to start is the S&P 500 Dividend Aristocrats. These are S&P 500 stocks increasing their dividends for 25 consecutive years. Let's take a look at the best dividend stocks to hold forever. 10. The Procter & Gamble Company, NYSE PG. The Procter & Gamble Company, NYSE PG, is a giant in the consumer staples industry, being the company behind many big consumer brands such as Gillette and Pampers. The company has raised its dividend consecutively for the past 65 years, making it a reputable dividend king. In the fiscal second quarter of 2022, the company had an EPS of 1.66, beating estimates by 0.01. Its revenue was $20.9 billion, also beating estimates by $617.4 million. The Procter & Gamble Company, NYSE PG, has also gained 3.8% in the past 6 months. The number of hedge funds holding shares in the Procter & Gamble Company in the fourth quarter of 2021 was 67, with a total stake value of $6.6 billion. In comparison, 69 hedge funds held stakes in the company in the previous quarter, with a total stake value of $6.4 billion. The Procter & Gamble Company, like Johnson & Johnson, NYSE J&J, and the Coca-Cola Company, NYSE KO, is among the most reliable dividend stocks to buy in 2022 because of its history of dividend increases. 9. VF Corp, VFC. Over the past 5 years, an investment in VF Corp, NYSE VFC, has been nothing but dead money. Its shares are down 9% compared to a 55% gain for the S&P 500. How can an apparel conglomerate with such brands as Vans, The North Face, Timberland, Dickies, Supreme, and many others do so poorly relative to the index? That's the million-dollar question. VF Corp reported Q4 2022 results in early April. Sales grew by 12% over Q4 2021, excluding currency, to $2.8 billion, while its adjusted earnings per share jumped 67% to 45 cents a share. For all of 2022, sales grew 23%, excluding acquisitions, to $11.8 billion. On the bottom line, its adjusted EPS was 3.18, 143% higher than a year earlier. Although its Dickies brand didn't quite hit $1 billion in annual revenue in 2022, its sales were $837.7 million, 19% higher than a year earlier. It should get there in 2023 or 2024 at the latest, making it VF Corp's $4th billion brand. VFC currently yields a healthy 4.4%. 8. Cisco, SYY. If you're looking for a dividend stock hanging in there in 2022, Cisco, NYSE SYY, should be on your list. Its annualized total return year-to-date is 3%, about 20 percentage points better than the entire U.S. market. The food distributor is one of the world's largest, serving over 650,000 customer locations worldwide from 343 distribution facilities. In fiscal 2021, it generated more than $51 billion in revenue. In its latest quarter, ended April 2nd, Cisco sales grew 42.9% over Q3 2021 and 15.3% higher than Q3 2020. It continues to take market share in both the US and internationally. When you invest in a business like Cisco, you have to have the mindset that a little from a lot adds up to substantial profits. Its operating margin through the first 9 months of 2022 was 3.5%. Cisco's shares currently yield 2.5%. 7. Chevron. Chevron, CVX, $176, has weathered many energy booms and busts since the firm's humble beginnings in 1879 when an oil field was discovered in California. Over the years, the oil major has consistently been one of the most committed energy companies to its dividend, having made uninterrupted payouts since 1912. This stellar track record reflects management's conservative approach to running the business. Chevron maintains a conservative amount of leverage, earning the company a pristine AA credit rating and providing borrowing capacity to protect the dividend whenever oil prices experience a cyclical decline. By continuously investing in technology and taking out costs, Chevron has also reduced the price of oil it needs to cover its capital spending and dividend to just $50 per barrel, down from $55 in 2019 and the 80s not long before that. Overall, this integrated energy giant has both the commitment and the ability to protect its status as a dividend aristocrat in almost any environment. Investors looking for the best dividend stocks for retirement will find one in CVX. but they must be comfortable with the energy sector's high volatility and gradual transition to cleaner fuels. 6. UGI. UGI 4428 has paid dividends every year without interruption for 138 years and has raised its payout for 35 consecutive years. The regulated gas utility, a propane distributor and midstream services provider, owns a mix of essential businesses that produce dependable cash flow in all manner of environments. Even during the financial crisis of 2007 to 2009 and the pandemic of 2020, the company's operating cash flow remained resilient as homes and businesses continued to depend on gas and propane for heating, cooking, and other critical needs. UGI is also looking to the future, acknowledging that its fossil fuel-dependent business may need to eventually transition to cleaner energy. The company is expanding its exposure to renewable sources of natural gas and propane, including gas harvested from landfills, and expects to leverage its infrastructure with other cleaner energy sources such as hydrogen. Overall, UGI expects to generate 6% to 10% annual earnings per share growth over the long term. This will fuel 4% annual dividend growth, keeping UGI an appealing stock to help fund retirement. 5. United Parcel Service. The world's largest package delivery company, United Parcel Service, UPS 18023, has been in business since 1907. Despite operating an extremely capital-intensive business, UPS has paid uninterrupted dividends since 1969, reflecting several competitive advantages. Most notably, few companies can afford to invest in the global fleet of trucks, aircraft, and distribution facilities required to deliver millions of packages per day in a timely and reasonably affordable manner. According to market research from Grand View Research, the global e-commerce market is expected to grow 14.7% annually through 2027. As this plays out, UPS has an opportunity to spread its high fixed costs over a large number of goods, improving its operating efficiency and profitability. While Amazon.com, AMZN, has made inroads establishing its own delivery network over the past decade, the continued rise of online shopping should provide a healthy amount of growth opportunities worldwide for the industry and keeps UPS's dividend on solid footing. 4. Duke Energy. Duke Energy, DUK 11179, has established itself as one of the steadiest dividend stocks in the market. In fact, 2022 marks the 96th straight year that the regulated utility has paid a cash dividend on its common stock. Unsurprisingly, Duke appears on SimpliSafe Dividend's list of the best recession-proof stocks. Argus research analyst Marie Ferguson views Duke positively as well, noting that the largest electric utility in America benefits from its presence in fast-growing states such as North and South Carolina and Florida, as well as from its strong balance sheet. Duke's investment-grade credit rating supports the company's plans to continue modernizing its infrastructure and build out its portfolio of renewables. Management targets 5% to 7% annual earnings per share (EPS) growth through 2026, which should support a similar pace of dividend growth for income investors, and keep DUK on this list of the best dividend stocks for retirement. 3. Kimberly-Clark. Founded in 1872, Kimberly-Clark, KMB 13179, is one of the oldest dividend aristocrats with a track record of 49 consecutive annual dividend increases. The consumer staples giant sells a variety of tissue and hygiene products under well-known brands such as Huggies, Kleenex, and Scott. Kimberly-Clark's products are so popular that they are used by 1/4 of the world's population daily. The company has built leading market positions through its hefty advertising investments and innovation, including inventing 5 of the 8 major product categories it competes in. Diapers, paper towels, tissues, and toilet paper are very mature product categories, with demand generally tied to population growth. However, their essential nature makes Kimberly-Clark a cash cow in all types of economic environments. 2. Southern Co. Regulated utility companies often provide generous dividends and dependable growth due to their recession-proof business models. This has made utility stocks popular holdings in many retirement-oriented portfolios. The utility serves 9 million electric and gas customers primarily across the southeastern U.S. Southern's footprint in states such as Georgia and Alabama give the utility several appealing traits. Southern benefits from favorable regulatory environments and fastest-growing local economies in its service territories, writes Morningstar strategist Travis Miller about SO's rate-regulated utilities. The result is a predictable business with constructive regulatory relationships, helping Southern in recent years maneuver through a rocky stretch of delays and cost overruns with some of its clean coal and nuclear projects. Looking ahead, Southern targets 5 to 7% annual adjusted EPS growth, and dividend growth could soon accelerate to match that pace as Southern completes work on its nuclear power plants. The utility is one of the best dividend stocks for retirement that should continue extending its 21-year payout growth streak. Number 1. Toronto Dominion Bank. Toronto Dominion Bank's TD 7704 earliest predecessor was founded in 1855 by a group of grain millers, marking the humble beginning of what would become one of the largest financial institutions in North America. TD generates most of its revenue from basic lending businesses such as home mortgage and fees from insurance products, asset management, and card services. Compared to many other big banks, TD has relatively little exposure to riskier and more cyclical businesses such as investment banking and trading. TD's conservatism is also reflected in its financial practices. The bank maintains capital ratios much higher than the minimum levels required by regulators. Management's conservatism has helped TD weather many economic cycles to become one of the 10 largest banks in North America. Its scale and network of retail locations has given it a massive base of low-cost deposits, enabling its lending operations to earn a healthy margin and providing the bank with opportunities to offer a wider range of products to clients. Which one of them would you like to buy and hold? Thanks for watching.